Hello and welcome to Business Today. I am Siddharth Zarabi and you're watching Easynomics. On today's Easynomics, we discuss once again the Reserve Bank of India's unexpected surprise hike in the rate at which it lends money to banks, which is called the Repo rate, hiked on Wednesday by 40 basis points with veiled indications that perhaps further hikes are expected in the weeks and months ahead. And this hike in the key benchmark interest rate also accompanied by a hike in the cash reserve ratio, which effectively sucks out 87,000 crore rupees of money from the banking system. So on one hand, the RBI has hiked the lending rate to 4.4%. It has also hiked the CRR. The net impact, as the RBI hopes, is that it will be able to anchor inflationary expectations and reduce the demand side push effectively on inflation and prices. In all of this, what will the consequences be? The consequence that we have already seen play out is that all banks will raise their lending rates to individual borrowers, to you and me, even to commercial borrowers down the line. Now, we have seen two banks, ICICI Bank, one of the largest private sector institutions, and Bank of Baroda, one of our public sector banks, already revise their rates upwards. All banks are expected to follow suit. We are waiting for the biggies. And the biggies like State Bank of India and HDFC will also respond. It's not just as if loan rates will go up. One of the consequences of this move is also that fixed deposit rates, which is the savings rate and still in India one of the largest instruments used by ordinary savers, which has high liquidity, although it is taxed in comparison to other products, people will expect, savers will expect that those rates also go up. We'll have to wait for that as well. But if you're a borrower, and you're a borrower especially in the home loan segment, it's very clear. The interest rate cycle has changed. I'll take you back to 2018 when it was the last time when an interest rate hike was announced. Post which 2019, the general election came, we saw a new cycle begin, and then we were hit by the COVID pandemic over 2 years back in March 2020. The Reserve Bank of India responded very quickly after the COVID pandemic and cut interest rates twice. In fact, on the 27th of March 2020, if memory serves me right, and it followed it up with another cut, effectively cutting our interest rate, the repo rate, by close to 125 basis points. Now, what the RBI did is not only has it hiked and taken away 40 basis points from that, it's also conveyed that it is now going to be focused primarily on inflation control. And it is chosen to use one of the biggest instruments in its arsenal, which is the repo rate, which is the benchmark lending rate for RBI to banks. There are, of course, those who raise the question of how effective it will be, considering that inflation in India in the current phase, in the recent few weeks and months, is supply side inflation. Now, what does supply side inflation mean? Aside of all the economic terms, it's very simple. What we have been seeing, including food inflation, is on account of the hikes in petrol and diesel prices. And mind you, this is something that very few people are paying attention to. The clock, the meter for petrol and diesel price hikes stopped on the 6th of April. That was the last when you had those 80 paisa hikes. It's been a month now that petrol and diesel prices have not been hiked. So one of the key reasons for a cost push has been stopped by the government of the day. But it's obviously very clear that that cannot remain the same. This is the second instance within this year when petrol and diesel prices have not been hiked for an extended period of time. The same situation prevailed earlier prior to the assembly elections. But at some point of time, one could expect that if crude oil prices keep rising, then the pass-through will happen. The government has tried, in fact, to even buy cheaper Russian crude oil, and that came with some amount of geopolitical risk and diplomatic risk, but that was the commitment of the government as far as oil prices are concerned. But the Reserve Bank of India seems to have also been cognizant of the fact that its advice for cutting excise duties was not acted upon as far as petrol and diesel is concerned. So the RBI has done what it could do as the monetary authority of the country, which is to suck out liquidity and make money costlier. There is, of course, this whole debate about how expensive money should be in an economy like India, in a country like India, which is a growing country, which has a huge percentage of its population, which is yet to even have aspirational or basic lifestyle. And that is why the cost of funds in India amongst the highest in the world. I mean, obviously we cannot compare ourselves in this regard directly to the US or Canada or the Eurozone, where interest rates range between 0 to 1% at maximum, and we cannot also compare ourselves to Brazil. But very clearly, the cost of funds in India are remaining expensive, and the constraints and the weaknesses in our overall system impacting individual borrowers. Let me just give you one more example. The amount of toll that you pay per 100 kilometers in India, especially if you live in a large megapolis, in a large metro, and that is not indexed or captured anywhere in the inflation rate. If you look at so many other commodities in your daily consumption basket, they are not captured fully in the inflation index that the RBI and the government uses. So it's a bit of a mixed bag when it comes to inflation measurement in India. And I, for one, have always believed that monetary policy has severe limitations, especially when it comes to food price inflation. However, the Reserve Bank of India is acting as per classical textbook economics, which is to anchor inflationary expectations. We'll have to wait for the jury on whether this first phase hike will have an impact on that, because it's very clear if petrol and diesel prices were to start rising again, they will in one stroke wipe away whatever this 40 basis points hike may or may not do for inflation and inflationary expectations. So finally, if you are a borrower, you pretty much have no option. The interest rate cycle has turned, and it has turned away from an era of relatively low interest rates to an era where interest rates are set to climb further, even beyond what has happened now. And depending on the geopolitical situation and depending on what happens in the next 90 days, and I repeat, in the next 30 to 90 days, what happens as far as inflation numbers are concerned will determine the Reserve Bank of India's strategy, because some experts are blaming the Reserve Bank of India for having been late and now trying to catch up in a cycle where even the US Fed has hiked rates. So beyond the ordinary, beyond the Aam Aadmi's consumption basket, at the higher levels, it's very clear that money is now becoming expensive, and central banks across the world are going to use interest rate hikes to try and cool prices, which has seen unprecedented surge all across due to a variety of factors, including the Russian invasion of Ukraine. So we'll keep tracking it very closely. If you bank with any of the Indian institutions, which you obviously do, please be prepared to get a little bit more, hopefully, for your fixed deposit, but to shell out much more if you are going to go out and get a home loan. But as always, there is an opportunity factor, and you only live once. If you have the money, if you have a monthly income that supports borrowing, go ahead. Real estate prices are perhaps still better off than they were earlier a few years back. With that, it's a wrap on this episode. As always, I'll request you to share, subscribe and like Business Today. Write in with your suggestions and we'll try and address them. Till then, goodbye.
If you like the video, do like, comment, share and subscribe.